Hello, everyone, and thank you for joining today's webinar, Retirement Planning for Physicians Amidst COVID-19, presented by Altfest Personal Wealth Management. My name is Jesse Frailing, and I'm the Director of Retirement Plan Services here at Altfest, and I will be your moderator for today's webinar. First and foremost, on behalf of our entire team, we want to wish continued health and safety for you and your families. Physicians such as yourselves are on the front lines of this pandemic, and we wanted to thank you once again for your service and for making the world a safer place for all of us. We would like to also recognize the associations which Altfest is proud to partner with, including the Medical Society for the State of New York, the New York chapter of the American College of Surgeons, the Medical Society of the County of Kings, as well as all societies and chapters whose leadership and members are in attendance today. It is a privilege to work with many of your colleagues as clients of our firm and to have the opportunity to continue to provide a range of benefits as well as timely content and education. Quickly, if you aren't familiar with Altfest Personal Wealth Management, we were founded in 1983 and we currently manage about $1.3 billion in assets on behalf of our clients. As a fiduciary and a fee-only firm, we do not sell any products or receive product commissions. We always put the best interests of our clients first. We offer comprehensive financial planning and investment management, and we specialize in providing services tailored to physicians throughout their careers and into retirement. And now I'd like to introduce today's speakers, Carolyn Yoon, Mike Prendergast, and Jimmy Bassett. Carolyn is a financial planning specialist and is also a CPA. Mike is one of our firm's tenured directors and financial advisors, and Jimmy is a senior financial advisor here at Altfest. All three have deep experience working with Altfest's physician clients. We will be kicking off the webinar today by first providing an update on the COVID-19 relief programs, which Carolyn will take us through. If you've attended previous webinars, then you may know we certainly stay on top of all regulatory and legislative updates which affect our clients' finances. We are here to help and be a resources for you. So if you have any questions about anything coming out of Washington or anything else, please do not hesitate to reach out to us. After Carolyn's update, both Mike and Jimmy will speak about the following topics: risks in retirement planning and how to manage them, timely retirement planning opportunities, and how to evaluate where your retirement plan stands today. We will finish up with a Q&A at the end of the presentation. If you do have any questions, please feel free to type them in the chat box on the right-hand side of your screen. We will do our best to answer all questions live. However, if we do not have time to get to your question, we will certainly follow up with you over email. And with that, I will turn it over to Carolyn to begin the presentation. Carolyn?
Thank you, Jesse. As Jesse mentioned, my name is Carolyn Yoon. I'm a financial planning specialist here at Altfest, and I'm a CPA as well as a CFP. I perform a lot of the tax planning, tax strategy, and implementation for our clients and just general retirement planning. So Altfest continues to monitor all of the top legislative changes that we're seeing happening that could impact your financial situation. At the end of last week, we were anticipating the passage of something called the HEALS Act in the Senate. However, it did not pass. In lieu of that, President Trump signed 4 executive orders over the weekend on Saturday. And I'm going to review these orders with you today just to make sure you understand how they might affect you, your practice, or your family members. The first order that was signed has to do with unemployment benefits. Specifically, it's allocating $44 billion to disaster relief funds, of which $19 billion will be used towards federal payment of unemployment benefits between the period of August 1st and December 6th. It's authorizing $400 per week of unemployment benefits to eligible recipients as long as states pay the first 25%, which would be $100 per week, of the additional benefit offered. If states don't have the funding to pay or the disaster relief funds are depleted, unemployed individuals will not receive this additional benefit. The second order has to do with evictions. So the CARES Act imposed an eviction moratorium, which lapsed in July. This order does not extend that moratorium. Instead, it issues 4 guidelines. First, the Secretary of Health and Human Services and the Director of the CDC are instructed to review if measures halting residential evictions would be necessary to halt the spread of COVID-19. Second, the Secretary of Treasury and the Secretary of Housing and Urban Development are instructed to identify if there are any federal funds available to provide additional relief. Third, the Secretary of Housing and Urban Development is instructed to provide assistance to public housing authorities and affordable housing owners and recipients. And lastly, the Director of the FHFA is instructed to review resources which might help prevent evictions and foreclosures for renters and homeowners. The third order that was signed has to do with payroll tax. This order defers payroll taxes paid by employees, so specifically the 6.2% for Social Security and the 1.45% for Medicare. It defers it without any penalties, interest, or additions to the tax. This applies to only workers who earn less than $4,000 pre-tax on a biweekly basis, or the equivalent amount with respect to other pay periods. The deferral period would start September 1st and it would end December 31st. The order also directs the Secretary of the Treasury to explore whether this tax deferral could not be owed at all by the end of the year. And then lastly, the last order has to do with student loans. So currently, loan payment requirements are paused and interest is suspended on federally held student loans until September 30th. This order extends that student loan relief granted under the CARES Act until December 31st. I hope you found these updates interesting, and I'm now going to turn it over to Mike, who will continue the discussion on retirement planning.
Hello, everyone. Thank you so much for coming today. We really appreciate your time. I'm Mike Prendergast, and I'm one of the directors of the firm. I'm also the director of the dental practice group, and I've been working with physicians for, this is my 19th year. So looking forward to talking to you about some retirement planning topics, so let's get right into it. First, let's talk about some risks in retirement planning and how to deal with them. So the number one concern from a financial planning perspective that mid and late career physicians have is planning for retirement. That's the thing they're most concerned about. And that's understandable because that's also the number one planning or financial concern that the general population who are in their mid to late career are having. Next slide, please. But it's very interesting because even though this is the number one financial concern that people have, physicians or otherwise, very few people know where they stand regarding this question, and just as importantly, how to successfully get to where they want to go. So, we talk with a lot of physicians, our physician clients, physicians that we meet, and through talks in person and webinars, and they often ask us, Mike, how much money do I need to save for retirement? What is the magic number? I wish I could give a magic number, but unfortunately the answer is it really depends, and it's different for each person. So why is this, and why is this question so difficult to answer? Let's take a look. The reason is because there are some things that we really need to carefully consider. One, unfortunately, is we don't know how long we're going to live. So we need to plan and make assumptions for that. We also don't know how our investments will perform over time. Another thing is that we don't know how inflation will affect our assets. Let's take a look at these one at a time. Longevity risk. This is also what we're calling about how to plan for when you might pass away. So I like this slide, but I realize it's a little busy for most people. The big takeaway here is people are living much longer in retirement than they used to be. If you look at the area in the chart where it says 95 years, basically the way to read that is that according to this research, ours is a little different, there's a 14% chance of a woman living into her until 95. There's a 7% chance for a man, and for a married couple, there's a 20% chance that one of them will live to 95. Now, we actually think that there's based on our proprietary research, for people like yourselves who are educated, affluent, have good access to healthcare, we think there's about a 10% chance that if you make it to 65, there's a 10% chance that you'll be living into your late 90s. And so you can see that this would be potentially 30 or more years in retirement. Next risk, inflation risk. Now, this is a risk that people don't really think about when they think about risks to their retirement. They think about investment risk because they see it on the news all the time. But most people aren't really tuned into inflation. And I see it as kind of like a silent thief that is slowly stealing the purchasing power of your hard-earned investment dollars to reduce the amount that you can actually purchase over time. So let's take a look at that. Here's some examples from 1976. So this was about 44 years ago. And you can see that a new home, average price of a new home, $48,000. There's no way you could really buy a home for $48,000, or at least in most parts of the country. Look at that, 13 cents for a first-class stamp. Now a first-class stamp is about, I think, 55 cents. So it's quadrupled in price. New York City subway fare, then it was 50 cents. Now it's $2.75. It's quintupled in price. And movie tickets, I mean, it varies depending on where you are in the country, but average price $2.13 in 1976. In Manhattan, movie ticket now for an adult, $15, $18. So you can really see that inflation is a real factor, and we really need to plan for it for a successful retirement. Another thing is investment risk. And so this is the risk that your investments will not grow at the level that you expect. And so when we prepare for investment risk, we choose return assumptions that are based on long-term historical data overlaid by our own economic and market outlook. And since, like I said, that retirement could last 30 years or longer, we think that the likelihood of our Altfest managed portfolios for our clients achieving our long-term return assumptions is very high. There's another risk that is specific to physicians, and that is the value of those people who have their own private practice. And this is the risk that the practice is not really worth what one thinks it is. Next slide, please. Great. So many private practice physicians do not have a good idea what their practice is worth. As I talk to physicians a lot, and I ask them about this, as we're always trying to identify risks for them, they'll say, oh yeah, I know generally what my practice is worth. And I say, well, how do you know that? And they say, well, I know some general rules of thumb, or maybe I know some practices have recently sold in my general area. But the bottom line is that these rules of thumb or anecdotal pricing can be way off. And if we don't really know what the practice is worth, then you really can't do quality retirement planning, because if the inputs are kind of squishy and all over the map, then the analysis and the recommendations that come out of it are going to be squishy and all over the map. So how can we manage some of these retirement planning risks? One is that you want to fund a retirement that has you living into your late 90s. There's a good chance that you won't live till your late 90s, but there's a 10% chance that you will, and hopefully you'll be able to live that long, happy, healthy retirement, and we have to plan for that. We want to take into account inflation's effects on your plan, because like we said, inflation can really have deleterious effects, so we need to plan for rates of inflation in the retirement planning we do. We also want to choose an investment portfolio that has a good amount of equities, even during retirement, so that your portfolio will actually be able to produce the growth that you need to be able to have a long retirement and be able to, again, mitigate the effects of inflation. Lastly, you want to get an independent, objective valuation of your practice so that you know where you stand and you can do more accurate retirement planning. Another benefit is that if the value of your practice is not what you'd like it to be, you still have likely several years to work on your practice to get it to the value that you know it's really worth by the time you sell. Also, what should you do if just continuing to do what you're doing doesn't result in a high probability of you having a successful retirement? Well, then there's some trade-offs that you can make in order to give your plan more financial strength to be able to carry you through that long, happy, healthy retirement. For example, you can delay your retirement by working longer part-time or full-time. Many of my physician clients, they love being a physician, but they don't really love the high stress of the full-time workload. So they can kind of reduce their hours, maybe going to 4 days a week, maybe 3 days a week. And so working, let's say, part-time, for example. Another thing is that they might reduce your annual living expenses. And conversely, when you're working, this also means increasing your annual savings rate. And you'll be surprised that even a little difference in the reduction of your living expenses will have a big impact on your plan's financial success, because all those savings compound positively over the decades. So a little can go a long way. Another thing is that sometimes physicians are open to selling your home sometime in, let's say, your mid towards later retirement in order to unlock your home's equity and to be able to fund the later half of retirement. And other of our clients, if they're open to it, are considering selling, maybe moving to a low-cost area in the United States where they can have the quality of life that they want, but they can also have a lower expense structure, again, to fund their long and healthy retirement. So let's look now at the next topic, which is some timely retirement planning opportunities. The first one I'm going to talk about, which is very timely for this year, is potential Roth conversions. So what's a Roth conversion? Basically, just to refresh quickly, it's moving your assets from a traditional IRA into a Roth IRA. And you'll need to pay ordinary income tax rates on the converted funds that are going from the traditional into the Roth. The taxes are realized in the year that the conversion occurs. Next slide, please. Great. So, why do a Roth conversion? What are the possible benefits? Well, there are several. One is that it really works if you're able to pay taxes now at a lower marginal tax rate, and then avoid paying taxes later at a higher marginal tax rate. Also, once you pay the taxes, Roth assets will grow within the Roth IRA account tax-free, underlying tax-free, until they're withdrawn. And the original account owner of the Roth, or if it's passes away and he or she gives it to their spouse, they don't need to take any forced distributions from the Roth IRA over their entire life. So it can just keep growing tax-free. And then even if they leave, the remainder to, let's say, their children or some other non-spouse beneficiary, there's no income tax burden for those beneficiaries. Why this year could be a good year? Well, many of our physicians are reporting that they might have lower taxable income this year due to lower compensation because of the economic effects of the coronavirus. Also, for some of our older physicians, this year, because of the CARES Act, you don't need to take required minimum distributions from your IRAs. So that again means less income on your tax return, less taxes to pay. Another thing to think about is that, again, because of the coronavirus, the government has increased fiscal spending a great deal to help businesses, people, and so on. This has caused a lot of borrowing. $3 trillion so far. House and the Congress and the executive branch are now deliberating on how much additional to spend. But the bottom line is all that money is going to have to be paid back eventually. And one of the ways in which it could be paid back is by raising tax rates, especially on the affluent. So tax rates could be going up in the future. Another thing is that if the assets that are in, let's say, your traditional IRA account are temporarily down. And right now, things have kind of recovered to almost where they were before the coronavirus, but we expect a lot of volatility this year. So if for some reason, your assets in the traditional IRA are down and you convert, it's a very good idea because you transfer the assets in kind, you pay taxes on that lower value of those assets. And once they're in the Roth IRA, they over time will grow back to their real value, and all that growth again will be tax-free. However, in the next slide, there are some caveats before you convert. It doesn't work for everyone. Everyone's situation is case specific. Here are some caveats. One, you need to, in order for a Roth conversion to make sense, you need to be able to pay the taxes due out of taxable assets. What do I mean by taxable assets? Like, your checking account or your savings account or anywhere that you have cash that's in non-retirement accounts. That's going to be the way to make the most dollars go into your Roth IRA account to get the maximum tax-free growth over time. Another thing is that if you think that you're a person who may be going into a lower marginal tax bracket in the future, then it probably won't make sense to do a Roth conversion. So, for example, if you think you'll be in a lower tax rate in retirement, or you plan to move out of state to a lower tax or a no income tax state, like perhaps Florida, then again, it would not make so much sense to convert. Another thing is that if you're very charitably inclined and have earmarked a lot or all of your IRA assets, traditional IRA assets, to go to a charity, that's also a negative factor in determining whether a Roth IRA makes sense. The bottom line is that Roth conversions could potentially have a lot of benefits for you. However, there are many factors to consider. There's no one cookie cutter approach, one size fits all. And so it's very important to consult a financial professional who knows about this carefully, as well as your CPA, to make sure that no stone is unturned to do the due diligence. Next topic. We get, like I said, we're talking with physicians all the time, our clients and physicians that we meet. And we're always hearing that, one of the constant refrains is getting hit with very high taxes. Mike, what can we do? We're getting hit with huge taxes. We know that the state and local taxes and the property tax deductions are now capped. Many physicians are concerned that maybe they've not yet saved enough for retirement, but they're well into their career. And because of that, they want to turbocharge their savings in retirement. Another possible solution is to create a workplace retirement plan for your practice. Now, this is specifically for practice owners, but for people who are hospitalists and physicians, you want to get the maximum benefit out of your own workplace retirement plan at the hospital, and I'll talk a little bit about that. But for private practice physicians, you have the opportunity to choose your own workplace retirement plan. So you have the opportunity to tax defer usually much more into your own workplace retirement plan than employees of companies. And you can choose a workplace retirement plan now that best suits your needs, and then change it over time as your needs change, which is a great aspect. Benefits for the practice. Again, it helps recruit and retain quality employees. It reduces employee stress and allows your employees to give the high quality service to your patients that you want, because it helps them reduce their stress, because they know that you've got their back, that you put in place a vehicle where they will be able to plan and prepare for their own retirement and those of their family members. Also remember that a practice receives a tax deduction for the funds that it contributes to a retirement plan on its employees' behalf. Also, there are benefits for the owner and the employees as well. And one, like we said, money put into a workplace retirement plan on a pre-tax basis reduces this year's tax bill, which is great for owner or employee alike. It also enables the investments that are in the pre-tax retirement account to grow faster due to tax deferral and avoiding a second tax, which I'll show in the next slide. And if your tax bracket is you expect to be lower in retirement, then the workplace retirement plans can provide even more benefit. Let's take a look. So here we have two physicians, Laura and Lenny. Laura, and they both think that they have $55,000 to invest. Laura decides to open up a workplace retirement plan as a 401k. Lenny says, I don't want to bother with this. It seems like a headache. What's the benefit? I'm just going to invest from my brokerage account. So how does it work? Laura, she invests $55,000. Now, since it's on a pre-tax basis, no taxes are taken out. She starts investing $55,000. Then if we assume that it grows at 10% a year for 30 years, it gets to about $959 in this example. Then if we assume that her ordinary income tax rate, federal, state, city, and so on, is about 40%, we take 40% off the top, and Laura nets $575. What happens to Lenny? Lenny thinks he can invest $55,000, but remember, he's paying with after-tax dollars, which means he has to pay the taxes up front before he can invest $1. So 40% gets taken off the top, $22,000. He starts out with $33,000. Then that $33,000 grows at 10% a year for 30 years, and it gets to $575. You'll see that that was the number that Laura ended up with. But unfortunately for Lenny, he doesn't end up with that number. He ends up with less. Why? Because as it's growing in a taxable account, he's being taxed on it. He's paying ordinary income taxes on interest, ordinary income taxes on non-qualified dividends. He's paying capital gains rates on qualified dividends, on capital gains distributions whenever he sells an investment. So assuming at a capital gains rate, like I said, federal and state of 20%, he nets out at $460. So here's an example where $115,000 less because of workplace retirement plan versus just no plan at all. So in conclusion, before I turn it over to my colleague Jimmy, with a workplace retirement plan, you want to consider your practice's cash flow, the amount and stability, and your annual savings ability to be able to contribute to the workplace retirement plan. And I should say for hospitalists, what you'd want to do, if possible, potentially is to max out on the amount that you can contribute to the hospital's 401k plan, if it makes sense, because you want to consult with your financial advisor. But at a minimum, you want to make sure that you contribute as much as possible to get 100% of the match that the hospital gives you, if in fact they're providing a match. You want to work, a physician in private practice wants to work with a physician-focused wealth management firm to determine the best option. We have a lot of deep expertise in this area, and actually Jesse is an expert in retirement plans for small businesses. And lastly, you want to then execute. Many people think about things, and you can think about things till the cows come home, but the bottom line is, do you execute? And if you execute, you're going to be able to reduce current taxes, increase tax-deferred growth, and achieve financial independence faster. I think we can all agree that those are three good things. And now I'm going to turn it over to my good colleague, Jimmy Bassett, who's going to talk to you about how to evaluate where your retirement plan stands today. Take it away, Jimmy.
Thank you, Mike. And hello, everyone. As Jesse mentioned before, I am a senior advisor at Altfest. In addition to working with a number of medical professionals, I am also a member of the firm's financial planning committee. So today, what we're going to get into is go back to kind of the main question that we started with in the webinar, which is what determines a successful retirement plan, or how do I know if I'm on track? And what we like to be able to answer to determine something is a success is we like to be able to say that we are confident that you will be able to maintain your lifestyle that you want for the rest of your life. Now, I'm going to dig into exactly what that means and how that translates into the core elements of our planning. So when we're talking about maintaining or funding retirement, that comes through on inflows. So that digging deeper down, that's going to be anything that comes in income-wise, like Social Security, pensions, annuities, and then the other second large component of this is your investment earnings. So what you're returning and what you're starting with with assets to grow. Then we move on to the lifestyle part of that response. So the lifestyle is going to be all of your outflows. Chiefly, it's going to be expenses such as general living expenses, the cost of your home, medical expenses, anything to children. I'm going to call back a little bit to what Mike had discussed, inflation. This is a key element that we take very seriously when putting plans together, because as Mike mentioned, it's the thief in the night that really comes into play, not necessarily as much next year or the year after, but way down the line. When we're talking about what a dollar can buy. The other element, of course, is taxes that you can't get away from. What we use in developing planning for our clients are some software that's able to estimate taxes that come into play, not just for the income that you're earning, but also the investments and the income that comes through there as well. And then the last element, planning for your full life. That's the time period, the time span that we're planning for. And that really comes into play starting at when you're deciding to retire, and then using appropriate expectations and assumptions for life expectancy. We want to be confident that everything is going to come together to last for your full time period. We don't want money running out before the end. So what I'm going to get into next is a little bit about the approach that we used for our clients when we're creating a detailed retirement plan. This is the approach we take, and we find that it is a very methodical way of going through to make sure that we have a successful plan that we can feel confident in. So starting out, we want to make sure that we understand our client situations. For individuals such as yourselves, groups like physicians or medical professionals in general tend to have some unique situations that don't translate to all other types of clients that financial planners may come across. For instance, the way that you transition into retirement can usually be very unique. There's opportunities that are available to you that not everyone can take advantage of. Similarly, the types of retirement plans that you have in place come into play on how to be able to start drawing down from assets in retirement. So we want to make sure that we understand our clients very well, from both broadly and then down to the individual. Everyone's unique. There's going to be different plans in place and different options that we want to have available. So then as we're digging through, we do want to make sure that we capture all of the different pieces. There's a lot of moving parts when you get into a retirement plan, both as you approach retirement, transition into it, and then continue to live on in that retirement state going forward. So we want to make sure that we capture all the different nuances there so we can see the full picture. Now, part of that is also incorporating investments. We want to make sure that there's appropriate expectations for how investments are going to perform throughout this entire time period that we're looking at. It helps us feel confident that the assets are going to last the time period and fulfill the goals that they need to fulfill for our clients. And then the last part is accounting for the unknown. I think the fact that we've all been through some unexpected times so far for this year with coronavirus coming into play and how that's affected both our lives and our work, I think it's a very poignant example of just being able to prepare for what is unexpected and what can come around the corner. And we actually use some statistical analysis to help us doing that. I'll get into that a little bit more later. But again, by going through this process, it helps us become confident. And actually on the next slide here is a good example. This is an element from one of our plans that helps explain how all those pieces come together. So you can see all the elements here. So starting just at the top, you can see that this is a 5-year cash flow, and it's one page of what can extend out to many to provide expectations and analysis through the entire time period. So we're definitely taking into account not just what's happening today or tomorrow, but for the whole time frame that we're looking at. And next, then we get into the input section that comes as a combination of both the investments that you see here, which we break out into taxable investments as well as retirement plans that come into place, because all of those translate differently when they're moving through a plan. When you're accessing those funds to live off of, whether it's coming from a brokerage account or a IRA account, can have a very different effect on taxes, and you'll see that translate through on the sheet here and as we go through planning. The other element, of course, is the general inflows of salary that's still coming in, Social Security, pensions or annuities. So we have all of that fuel that's coming into the tank, and then we move in onto the outflow section. So where everything's actually being used and applied to fund the lifestyle. So whether it's general living expenses or, like I said, tracking specific pieces like liabilities such as a mortgage. Those are pieces that may be in place now, but we need to have the expectations of when they may drop off or when new expenses may come into play. So you can see further down, we have unique expenses that come in and out to be able to account for everything from home repair to buying cars in the future to maintaining proper medical care. So all of that comes into play along with taxes, of course. And really those outflows and expenses can be a difficult element to really get our hands around. From my experience, clients definitely see that as kind of a big hurdle to get over, of feeling comfortable that they're capturing everything. So actually in the next slide, I'm going to get into some technology that we utilize to help our clients get there. And essentially, we are able to link in credit cards and checking accounts if clients choose to be able to get actual transactions, which our software then categorizes. But you can see here, you can actually make adjustments, you can teach it and set rules, so it's capturing everything accurately. And what this allows us to do is, with very little work, be able to make sure that we're getting accurate expenses that translate into the real world, so that the projections we're using are reflective of what's actually there. And what we're able to get through this, you can see on this slide, is kind of the full picture of what expenses look like over a time period. So we can see the general categories that they are. Now, again, we're not looking to see every time that you go to Chipotle in a month. It's more to get the broad sense of major categories to, one, make sure we're capturing everything, and two, giving us proper expectations for how living expenses and outflows might change in the future. So this helps us set up the initial plan, but also it helps us stay on track as we go through things. We're able to review and from year to year make sure that what's actually occurring is in line with our projections. And if there looks like there's a disconnect, we can help adjust and get things back on track. Now, moving on to the third element that I mentioned, investments. This is the other key area, because again, investments, along with what you have coming through an income in retirement, is going to really be fueling everything. So we want to make sure that we have appropriate investment expectations. So you can see here, there's the blended rate that we get depending on exactly what type of investment portfolio we're working with for each of our clients. And that needs to strike a balance in being conservative enough that we are confident that, again, the portfolio is going to be able to last for the full planning time frame. But also, we don't want to be too conservative, because that can lead to people either having to unnecessarily push off retirement or not feel comfortable to really spend the way that they want to spend when they're in that stage of drawing down in their life. So as investment managers and having a history in this, we ensure that our client portfolios properly align with retirement and planning goals to offer that long-term growth, but also manage the risk of what can come down. And that actually leads into my next slide here, is how we account for risk, how we account for the unknown. Because again, it's great to draw a straight line projection of being able to have investments grow every year and expenses have their inflation every year, but we all know that nothing is certain in the future, so we want to balance that as best as we can. And what you see here is a graph that represents a statistical analysis called Monte Carlo, and what it allows us to do is, using good historical projections or historical numbers along with our projections, be able to map out paths that your investments might take given the actual situation data that we collect from you. So based on having to draw down from the accounts over the years, but seeing that the investments can still fluctuate, it gives us a projection of where your assets might span over the years. So obviously, short term, there's a very narrow window, but it can get very large as we go through the years. But this gives us a confidence of, in general, where things might lead, and it can give us confidence on how successful that retirement plan is. So when we do finish the entire process, we can say that we feel confident that your assets will be able to satisfy the lifestyle you want for your entire lifetime. And so what I'm going to go into the next slide is kind of putting that all together and show you an example of what a plan can look like. So here, with all the inflows and outflows, we have the projection for clients' assets over a full time period. And again, this is straight line. So you can see that it goes up and we have assets growing, which is good. But we do want to test that in our Monte Carlo analysis to see what it looks like and what could happen. And you see down at the bottom here, the success rate, it's not bad, but it could certainly be better. It can certainly be in a way that could make us more confident. So what we're able to do when we're putting plans together is create some suggestions, things like moving the date of retirement, having different Social Security option choices or different contributions to 401ks. And you can see that the percentage of success actually jumps up much higher. And we can also see how this translates out on a straight line directionally to have a general improvement in the portfolio. So this is what we're able to do for our clients when we're putting together a full retirement plan, is kind of guide them through that process of where they are, adjustments they can make, and where they can ultimately expect to end up. And so what I'm going to talk about next is actually a benefit that we're offering right now to MSSNY members and for those that are watching our webinar today. This is a retirement readiness report. I have a few excerpts from that. And while this analysis isn't as rigorous and doesn't go as in depth as what we do for our full clients, it does utilize those three main elements that I was talking about before: of time period, expenses, and having income. So the inflows, outflows, and time. So you can see on the right-hand side here, we do have our time period listed of when retirement's starting and our expectations of a full life expectancy. And then below that, we get into the core element of outflows. So having an accurate living expense number to go off of, as well as having some tax rates to account for taxes. And then off to the left, you see our assumptions for growth, as well as what that will be affecting. So the actual assets and investments, both qualified, so those are going to be retirement assets, non-retirement assets, and any other sources of income like Social Security. And we're able to utilize and put all these together into analysis to get a bigger picture. So you can see on the next slide, it comes together. We can see an estimate of the total cost of retirement, giving those living expenses as well as the taxes, the retirement income that's going to be there to use. Chiefly, in this example, it's going to be coming from Social Security, as well as the assets that you're working with to try and fund it. And that gives us an idea of whether everything is acceptable enough to fulfill the expectations of the living expenses at this point, or whether in this case, for example, there's a shortfall and how many years are uncovered. So again, utilizing these straight line calculations, it doesn't account for everything unknown, but it gives a good general picture of where you're standing at this point. And if there is a situation where you're not quite making it, you'll see on the next slide, there are some general options you can look at. So whether it's potentially increasing your savings, reducing your expenses, or adjusting the timing of your retirement, you can see how making some adjustments there can change that percentage to actually be fully funded. And again, this is something that we're offering complimentary to MSSNY members, as well as those attending the webinar today. If you're interested, you can certainly reach out to Jesse. And again, while this isn't perfectly comprehensive, this gives a good starting point to give you an idea of where you stand on kind of that framework of looking out into retirement. So that's going to end my presentation today. I think we're going to move on now to a Q&A session.
Thank you very much, Jimmy. And as Jimmy did highlight, we encourage all physicians to take advantage of our complimentary retirement readiness benefit. As Jimmy mentioned, it certainly serves as a valuable gauge of where you stand in relation to what your retirement goals may be. This is just part of Altfest's comprehensive approach to financial planning and investment management. As Jimmy said, we work with clients to identify opportunities to reduce their taxes, to reevaluate their insurance needs, to check if their estate plan may have any gaps, and much more. And we know that this is not necessarily the standard approach that you may have seen from other financial advisors. And if these are areas that you have questions about that perhaps your current advisor isn't addressing, we certainly encourage you to reach out to us. And as we have now reached the Q&A section of the webinar, before I read the first question, we are going to launch a very brief poll, and I will give everyone a few seconds to respond to that. So Max, if you wouldn't mind going ahead and launching that poll, that would be great. And then we can move on to the questions that we've received. And once again, I'll just give everyone a few seconds to answer that. And as people do respond, I will begin with the first question that we have received. The question is as follows. I heard that recently the required minimum distribution rules have changed for people who have inherited an IRA. Is this true, and does it apply to Roth IRAs? Mike, I think this might be a good question for you to tackle.
Great. No, thank you very much, Jesse. And that's a very good question because, the rules have changed. And so what has happened is that the Secure Act changed the rules for beneficiaries who inherit an inherited IRA after January 1st of this year. It used to be, for the vast majority of circumstances, that once you received an inherited IRA, you were able to take out required minimum distributions over your life expectancy. However, for most people, that has been eliminated. And so what it's been replaced with is that if you receive an inherited IRA, you'll have to take the assets out within 10 years of the death of the original owner. Now, there are exceptions, notable exceptions to this 10-year rule, and that is assets left to a surviving spouse, assets left to a minor child, to someone who is disabled or who is chronically ill, or someone who is less than 10 years younger than the original account owner. And so those people, again, don't have to worry about the 10-year rule. Also, it's important to realize that this is true for both traditional IRAs and Roth IRAs. So that's a great question.
Thank you, Mike. Certainly correct. And thank you for that very thorough response. I'll move on to the second question that we've received. The question is, there have been numerous lawsuits against retirement plan sponsors for fiduciary breach in recent years. What steps should we be taking to ensure that we are meeting our fiduciary responsibilities to our workplace retirement plans? And this is also a section that Mike had covered. If you don't mind, Mike, I will take a shot at answering this. I think it's a very good question, and there certainly have been a number of lawsuits that have increased in volume in recent years due to fiduciary mismanagement of workplace retirement plans. In fact, in 2019 alone, there were about $2.5 billion in fines handed out by the Department of Labor related to ERISA-related lawsuits. ERISA, of course, is the legislation that governs workplace retirement plans. And what we say to our clients and what we implement for them, that's so important in not only doing your fiduciary duty to act in the best interest of your employees, your plan participants, but also, of course, having you avoid getting caught up in a lawsuit like this, is having a prudent fiduciary process in place and one that you can document as well. And what I mean by that specifically is implementing an investment policy statement. I would say that's the number one place to start when taking steps to document your prudent process that you're taking to manage and review your workplace retirement plan. In this investment policy statement, you will include things such as your process, how you select the investments for your plan, and how you monitor them on an ongoing basis, as well as other things as well, such as selecting a provider in a competitive situation where you're monitoring and assessing the fees that different providers are charging as well, that your participants are absorbing. So certainly fee monitoring and benchmarking should also be a key component of your investment policy statement for your plan. And in documenting your due diligence that you followed this prudent process will go a very long way towards helping to make sure that, once again, that you're, of course, doing the right thing and acting in the best interest of your participants, and also avoiding lawsuits. So I think that's a great question. If you do have questions on, what an investment policy statement might look like and implementing a prudent process to review and assess your retirement plan, if you currently have one for your practice, that would be certainly something that you can reach out to us for, and I'd be happy to discuss that with you. Moving on to question number 3. Do you use your software, to help your clients analyze all financial decisions, even those that don't necessarily have to do with retirement? Jimmy, since you were just taking us through some of our software's capabilities, would you take a shot at answering this question?
Oh, sure thing, Jesse. Yeah, this is a very good question. Actually, the answer is yes, we certainly do. The nice thing about the software is that it allows us to really get deep down into the weeds and really kind of customize situations. So we'll use the software and actually some of the presentations I just showed you in evaluating items anywhere from deciding to take certain insurance policies, whether that's long-term care policies or life insurance policies. Just last year, I actually helped a client who was looking to purchase a home to see what sort of effect that would have. So whether that's relocating or buying a vacation home, we can incorporate practically almost any situation. I know one of the other situations I can think of that may be applicable here is, selling a business, what that might look like. We can fold all of that into our retirement planning to make sure that we have the most accurate picture as possible and make sure that our clients feel comfortable in whatever decision they decide to end up executing.
Thank you so much, Jimmy. I think that you made a terrific point about analyzing those individual scenarios, such as obviously the purchase or selling of a home or a property that you may own. These are the types of scenarios that typically aren't included in sort of maybe traditional retirement planning software, or maybe if you have a workplace retirement plan, the record keeper's website may have some retirement plan tools that can help you assess where you might stand, but those almost always do not include the ability to analyze those very, very important scenarios that come up in life, as we know, that may not fit into a sort of a cookie cutter software or plan. So I think, Jimmy, that's a terrific answer. Thank you. I'll move on to the next question. Given Trump's recent executive order, are you advising your clients to cease withholding payroll taxes for their employees? Carolyn, we'll refer to you on this one.
Yeah, and this is a great question, and it's something that we're continuing to monitor. At this point, we're kind of giving the answer of not yet. So we are looking for guidance, official guidance, to come out from the Secretary of the Treasury and also the IRS to see if they give us any more feedback on deadlines. And also, we just want to kind of impress on our clients, especially physicians that have practices, the employer would end up becoming liable for any taxes not paid by the employee. And just a reminder that at this point in time, this is just a deferral. It is not saying that these taxes are not owed.
Very important point, especially about the fact that it is a deferral. Very good point, Carolyn. Thank you. The last question I have that we've received is, what is the safest place to invest now? Since I'm partially retired, should I be buying gold, COVID vaccine company stocks, or just take all my money out of the stock market and stuff it under my mattress? I think that's a great question as well. Jimmy, you, part of your section of the presentation did discuss our investment component that certainly factors very heavily into our clients' retirement planning. And I think that as a group, though, we can probably discuss and all take parts in answering it. But Jimmy, maybe I'll start with you.
Sure thing. No, I'll definitely take a stab at that to start off with. First of all, I think what's very important to keep in mind for those that are entering into retirement is that there's still a very long runway for people to consider. For many people, it's another 20, 30 years that they need to be able to utilize their investments and continue funding. So given that there still is a long time period, old thinking is definitely, all right, you're in retirement, you need safety, safety, safety. One of the things that's really tough in today's landscape is, traditionally that's meant bonds, and bond yields right now are very, very low. So it's hard to have that expectation of just having very conservative cash-like investments being able to be there for you long term. And that's where needing to maintain some equity, some stock exposure in your portfolio, I think is very important. Now, the way to do that and incorporate, those risks, as you saw, we have statistical analysis to take into account both, upside and downside in the market. Longer term, having a diversified portfolio can help you manage those risks to be able to take unnecessary risk off the table. Going through, I think even just this year as a microcosm, you've seen a very dramatic drop that we saw in March and April, and then a dramatic rise back up. And reacting too strongly to events like this can definitely get you into some trouble. So it's definitely something you have to balance. But I think you're balancing that potential risk, but needing to meet goals long term, and that's where I think having a very well experienced portfolio manager can help clients navigate through this situation. But Mike or Carolyn, you may have some other points you might want to tack on.
Yeah, Jimmy, I think you made some really great points. Just a few things that I would add is that, as we were talking about in the presentation today, retirement planning has multiple risks. And so it's really important to keep your eye on the ball, or more specifically, more accurately, on the balls. You can't just look at one thing. So I understand it's a very common concern of clients to be focusing on investment risk, the volatility day to day in the portfolio, because that's what's on the news. Dow up 10 million points, Dow down 10 million points. What should we do? It's a paradise. It's an Armageddon. What's going to go on? So that's important, but remember, there are other risks that are circling around you, kind of like sharks. And one of the risks is inflation, which we discussed. So even if you were to go to something that was very traditionally safe, and like Jimmy says, the returns on bonds are very low. When you take into account inflation, inflation isn't taking a break. Inflation is slowly eroding the purchasing power. So just maintaining the same amount of assets that you have isn't going to get you where you want to go in many cases. So be aware that you need to have usually, not always, but usually a significant component of equity in your portfolio to give your portfolio the growth it needs to at least mitigate fully the effects of inflation. But what we like to do is go past so that your purchasing power increases over time. The other thing to remember is that stocks are the most risky asset class, like we know. That's why they bounce around so much. But remember that you do get a benefit for taking on this volatility, and that is that over the long term, and if you're just about, like you said, you're just semi-retired right now, you probably have many years, hopefully to have a long and happy, healthy retirement. Over long periods of time, the best average rate of return of any asset class is in stocks. So remember, there will always be crises. There was the Cuban Missile Crisis. There was the war in 1973 between the Israelis and the Arab states. There was the crash of 1987. There was the 2008 crisis. So there will always be short-term volatility. But if you're able to kind of be calm, realize that this too will pass, you'll be able to make it to the other side and be able to enjoy that long, healthy retirement in the lifestyle that you've grown accustomed to, because you have some component in stocks and they will do well for you. Carol, do you have anything that you wanted to add?
Yeah, the only thing I would add to that is, one of the biggest benefits of working with an advisor is the aspect of, behavioral coaching. So being able to talk out your thoughts and your thought process, going back to your financial plan, making sure, what you're thinking is in line with the plan we've presented to you over, numerous sessions and meetings. And all of our advisors here at Altfest communicate in a two-way street. So as much as we reach out to clients, we expect clients to kind of reach out to us and discuss kind of their fears and their concerns as much as their victories in life. So definitely something you might benefit from, getting an advisor to kind of talk you through or off the cliff at this point.
Good point.
Terrific. Thank you to all three of you for tackling that question as well. At this point, we are coming up on 12 o'clock shortly here, and we've reached the end of our Q&A portion. We wanted to thank again everyone for attending this presentation. We certainly hope that you found it to be of value, and you can see my contact information listed here on the screen. You can reach me either at my direct line at 212-796-8732, or send me an email, which you have there on the screen as well, anytime. As well on the screen is a link to our physicians landing page of our website, which is altfest.com/physicians. And as one additional reminder, I encourage you to reach out especially to take advantage of the retirement readiness benefit that we mentioned a couple of times earlier in the presentation, as well as any general questions that you may have. As I said, we're here to help you and be a resource for you. So we thank you again for your attendance today, and we will see you next time.
Thank you very much.